Incorporating your medical practice can have huge advantages when used properly, but it also makes things a bit more complicated. Here's 10 concepts you need to know if you want to save taxes and reach your goals faster. Number 1, compensation. You can choose to pay yourself salary or dividends. Salary is deductible to the corporation and taxable to you personally. When you pay yourself salary, you generate RRSP contribution room equal to 18% of the salary paid. You are required to make Canadian pension plan contributions, and you have to make them twice, once for the company and once for yourself. With dividends, you don't generate any RSP room, you don't pay CPP contributions, and the dividends are not deductible to the company. Usually a combination of salary and dividends is optimal. Number 2, the small business deduction. In BC, the first $500,000 of active business income is taxed at 11%. That active income is the income that you generate from being a physician. Income over $500,000 is taxed at the general rate of 27%. If you have too much investment income in your corporation, it can reduce this $500,000 limit. Ways to avoid this include targeting tax-efficient investments inside your corporation, like those that generate capital gains instead of interest income, or by reducing the amount of passive assets you have. You can do this by paying yourself more salary and dividends so that you have less retained earnings, or in certain cases, you can transfer some of those corporate assets into an insurance policy. Number 3, holding companies. Holding companies can offer more liability protection, although they won't protect you from medical negligence. Holding companies can be used to separate the assets of your active medical corporation from your investment assets. When you retire, you're no longer able to have a professional medical corporation, and so any retained earnings that you've built up over your career will need to be moved into a holding company. Luckily, you can pay the holding company dividends from your medical professional corporation without tax. That allows you to keep the holding company through retirement and pay yourself dividends in order to meet your retirement needs. Number 4, passive income tax. The investments inside your corporation generate income, like interest and capital gains and dividends. And they're all taxed a little bit differently, but generally speaking, they're taxed at fairly high rates. So you want to target investments that generate tax-efficient income, like Canadian dividends and capital gains, inside your holding company or medical company. You can offset this by holding your interest-bearing investments like bonds and GICs in your personal accounts, ideally in tax-deferred or tax-free accounts like RSPs and TFSAs. Number 5, notional accounts, CDA, NERDTOH, ERDTOH, GRIP. What do these all mean? These are different types of accounts held inside your corporation that have different impacts on your personal and corporate taxes. Now note, these are not accounts held at a financial institution or a bank. They're tracked when you do your tax return, and generally your accountant will help you with this. CDA stands for Capital Dividend Account, and these are tax-free dividends that you can pay to yourself personally at zero tax. Most commonly, they are the tax-free half of any capital gains that were generated inside your portfolio. ERDTOH and NERDTOH are refundable tax on hand. This is kind of like a withholding tax paid to the government on certain types of investment income. When you pay yourself a dividend personally, your company gets a refund for a portion of the taxes paid on those assets. GRIP. GRIP stands for General Rate Income Pool. This is income in your company that's already been taxed at the higher general rate. This income usually comes from dividends that you've received in your investment portfolio or from any income you earned over that $500,000 threshold. This income, when paid personally, is taxed at a lower rate than regular dividends.